Hey everybody, hey traders, Chris Bowler here. It is 6:08 p.m. on Friday, August 23rd. Another week survived. We are in day two of Jackson Hole. Powell spoke today, got the markets all excited, and I want to talk about that amongst other things. So, tail of the tape, we had some good gains on the day. SPY with a gap higher. Price action intraday didn't do a whole lot, but we can see. So here's the E-mini futures. Here's actually a short-term chart here. So SPX. Let me just zoom in on the 5-minute time frame. So for the day, all we really had was a gap up, a little bit of noise, a little bit of noise. It really didn't do a lot. This is Friday, Thursday, Wednesday, Tuesday, and Monday. Just kind of looking back at the week. Overall, we really didn't go very far. We had a directional day Monday. We had nothing on Tuesday, Wednesday. Thursday direction to reset, and then Friday gapped up to finish positive on the week. We're still not at all-time highs on the S&P. We're still not at all-time highs yet on the Nasdaq. We're still not at all-time highs on the Dow. We're still not at all-time highs on the Russell. We are close, yes, but are we there? No. So next week will be a clean slate, and we'll see what's going on. We're going to finish up the month. August 30th is Friday next week. We do have NVIDIA earnings on the 28th, Wednesday after market. We have core PCE for the U.S. on Friday as well. A couple of things to digest before we get into September. I wanted to spend some time on this chart here because I believe that we're in an interesting phase where this could either be, a rate cut cycle like we saw back in 1998, or this could be a rate cut cycle like we see typically with the Fed, where things are getting cut in the wake of an inflation or wake of a slowdown, and that's not a good sign. But let me just use a vertical line here. If you see my cursor, go back to this rate cut cycle here from 1995 into 1996. Markets were pretty slow, but they did ramp up, into the late 90s. And then this was an interesting cut cycle here in 1998. In fact, I just did some simple chat GPT about this 1998 rate cut cycle. The context was the Fed cut rates in September 1998 in response to the long-term capital management crisis and global financial turnover. Over the next 12 months, the S&P increased by around 40%. Despite the initial fears, the U.S. economy remained robust, and the cuts fuel a continuation of the bull market. So the question is, are we going to see that type of behavior? If this, 1998 rate cut led to additional gains in the stock market, we did have a pullback in here in summer of 98, and then by late 1998, we were at all-time highs going into 1999, 2000, of course, and then everyone got ready for the dot-com bubble in 2001. So I've got the Nasdaq on top, the S&P below, and then the Russell as well. So I'm primarily paying attention to what the S&P do at this time, what did the Nasdaq do at this time, and this is where I think we might be headed. So we're sitting here at 5.25% to 5.5%. Nobody really knows the true pace of the Fed's rate decisions, but once they start, they're probably going to be pretty consistent, at least on a Fed meeting by meeting, maybe every quarter. I'd be more along the lines thinking that we're going to have 25 basis points for every quarter or so over the next year and a half. So I'll look at the watch tool. I think the watch tool shows that the Fed expects to be around 3 to 3.25% by the end of 2025, or at least as far out as September 2025. The question that the market's asking right now is, are we going to cut 25 basis points in September or 50 basis points? And then again in November, December, is it 25 to 50 basis points? The market remains pretty mixed and the numbers keep changing. But I think the one thing that is pretty certain right now is that there will be a cut cycle that starts. And Powell made it pretty explicit today that that cut cycle is starting in September of 2024. So just let me digest this a little bit further. This rate cut here in 1998 did lead to additional expansions and all-time highs in the S&P as well as the Nasdaq. We started to see that they then went into a rate hike cycle shortly after. We went from 5.33 to, let me see the numbers here. So we had 4.6% on the cash rate to about 6%. So we somehow raised rates 2% as the market was expanding. That's the one thing I think is different, is we're not going to start cutting in September 2024 and then turn around a year later and start raising rates. I don't think that's the case. So I'm not saying that we're not there, but something tells me that we're likely more inclined to see something closer to this 2000, 2001 rate cut cycle where we were sitting here. Here's the Fed funds rate. The cuts begin in late 2000, early 2001. We go from 6% and we slash all the way down to sub 1%. And of course, we know that there's a dot-com bubble. We know that tech burst. We know that some major stocks and indexes. I mean, the NASDAQ was down, I want to say I think close to 80%. Individual stocks were down way more than that. The S&P had a huge decline as well. So, you know, not a great sign if that's where we're going to be as far as slashing. Now, the difference between 6% down to, 1%, well, I mean, we're already looking at talking 6% down to 3%. So what's the difference between 6 and 3, 6 and 0, 6 and 1? Or if we go from 6 to 3, then back from 3 to 6, I don't know. It could be, very messy moving forward. I'm not bearish, okay? Not yet. But as I've talked about in other charts, I think we need to be cautiously bullish at these valuations. I do think that the market, even though today was actually a good sign of some broadening, let me go into current charts. Let me make this a little bit smaller here. This will be a little bit easier to dissect. Sorry about the chart mess, but let me just help you see through it. So I had mentioned in a video yesterday about potentially having. Let me go back to a higher time frame here. Something like this. If the market can't quite breach these highs, and maybe it can, but if the market struggles here going into September, if we can't breach the highs, we'd have lower highs and potentially higher lows. Or if we have some type of channel this way where it's high to low, lower high to lower low, this would be pretty disappointing if the market turns over and starts to fall. That would be more signs of a recession. Things would be causing a lot of worry out there. I don't think that we're there yet. I would be more along the lines of, look, we had a correction that a lot of signs point to a 5% correction, 12% correction, or I'm sorry, 5 to 10% correction. You look out 12 months, the market's typically higher. This was that discount, even though it was a really nasty weekend-based volatility event, it still happened. So I do think that since we broke this trend line here to the upside, we had some gains that got back to all these efficiency levels. So we took out this level, we filled that pocket, we closed out above that January or this July 31st and August 1st high. To me, this looks like any type of pullback is probably going to be bought, at least for right now, as long as earnings come in somewhat steady. I mean, Nvidia is going to be the big one to wrap up Q2 earnings, and then as long as we have employment data and inflation data that's not over the top. If we do that, we're likely going to be sideways and maybe some softer pullbacks, maybe some indecision here near the top. But if the market's looking for another catalyst, will we get it? So I could see some indecision over the next maybe couple of weeks as we head into September. Seasonally, September is usually a 0.7% down month. Over 70 plus years, it averages about negative 0.7%. So let's say that September is right along the lines of history and we have maybe a 1% drop and settles in around 0.7. Is that enough of a pullback to get the market, get the market around, okay, we've pulled back a little bit. We found some areas to start accumulating, and then we can get through where October, November, December is typically pretty bullish. And will we get back above this high from this week and possibly into all-time highs where this market may run and capitulate and run even hotter? I'm still cautiously bullish, but as we make these fresh highs, enjoy the gains, protect your profits. All sorts of good stuff can happen. I wanted to touch base today on also the rotation with the Russell doing very, very well and actually outpacing the other indexes. So the Dow is up 1.07, the Q is up 1.08, the S&P up 1.06, and the Russell just crushing it today at 3.19. So if we start to see S&P is still positive, NASDAQ still positive, Dow still positive, but the Russell is outpacing, I think that is a good sign for this market to be broadening and seeing some small caps get some love, maybe some of the larger caps, the S&P 500, like 490 other stocks getting some love and not just the Mag 7 or the top 10. So I think there's still some juice left to squeeze in this market to get to all-time highs. I think that'll make investors happy for 2024 with a nice year. But I'm pretty cautious moving into a capitulation move into 2025. And I would be looking for just, very obvious signs of topping patterns or breakdowns. If we're sitting here at 6,000, we want to look and see what is the price to earnings ratio. What are are we looking at historically high valuations? Do we need to come back to the averages around like 16 or 17 versus getting up there towards like 25 to 29, which ultimately has led to pretty nasty corrections in the markets. So that's where I'm looking at. S&P, where can we go? Let me just take this here. So we draw a trend line. If we have some indecision, where we just kind of keep struggling to break the highs, but maybe just a little indecision, maybe a little bit of a correction here. I don't think the bearish momentum necessarily picks up, but if we just pull back a little bit in here, I could see that being a spot where there's more accumulation opportunities. Get back to the highs. If we blow those highs off, awesome. That'd be a great way to finish out 2024. And this might be the market's destination either way. But once we get to 6,000 or slightly higher than that, I will be moving and trapping and playing a lot of defense at that point and making sure that I'm protecting a lot of profits, because I think from that level, more than likely this is going to start turning, and for good reason. I mean, just coming back to reality a little bit, but we're not there yet. So, like I posted yesterday, perhaps this is lower highs and higher lows if we have a lot of volatility to contend with, or if September is just the typical 0.7% to 1% lower, then maybe we just pull back a little bit into this gap area and we have a kind of a left tip, center tip, right tip pullback. Look for some accumulation in here, and if the market starts to go and we have a strong Q4 with the market, then Q4 looking for highs and see if this market can get to 6,000. If I go back to the start of the year, let me go back here on the slightly higher time frame. So if we get back to January of this year, should be right in this little indecision zone. Yep. So right here is January 2024. So obviously I'm going to be off by maybe a couple percent here, but if we get to 6,000, let's just say that's a profit target here on the SPX. We'll start right in here around January. Like I said, we had about a 1.5% pullback to start off the year. If we get up towards 6,000, that would be the index doing about 26%, between 26, 27%. Look, that's a great year for the market. Maybe on the high side we do 30 to 35. Does the Nasdaq outpace that with 35 to 40 plus percent? Maybe. Maybe we get up to the 20 to 25% zone, but I think that's a pretty good stretch. And if we hit it, awesome. Profit taking most likely will be my main objective. But if we take a look at where we are right now, September, if there's any type of seasonality, sideways to maybe some slight pullbacks, and then we see if maybe it's earnings season, maybe it's more employment and inflation data over the coming weeks. I do think that the markets need to see good data both ways. We want to see softer. We want to see softer inflation data. We want to see stronger employment numbers. And so with the news that's coming out, we'll have unemployment claims coming out every Thursday for the next couple of weeks until we have the Fed rate decision. We will have a non-farm payroll print. We'll have the ADP on Wednesday of that week of non-farm payroll. We will have core PCE. We'll have PPI and CPI. So it's enough for the market to digest inflation and employment before the September 18th decision. And like I said, I'm just going back to this chart here. What makes me, I guess what makes me optimistic would be that we are catching the Fed pivot pretty hard into, hey, we think inflation is under control. We're heading down towards the right direction. We're heading into that 2% target. We think we're going to get there, and now we're going to focus on making sure that the labor market is not cooling any further. And so that's where Powell came in today during Jackson Hole's speech and just really was way more explicit and definitive than he usually is. So I think the market liked it, but to what degree? Maybe it's wait and see for the market now. But are we about to see a cut cycle that starts that still gives this last, these last couple of innings of this expansion move? Does it give it more room to run and more evidence to run? Sure. Maybe it's the catalyst that the market needs to just get that last little bit of gains. And we could be surprised. I mean, we might see, who knows, 10, 15, 20, 30% upside for the next maybe 6 to 12 months before we get a real topping pattern happening. I don't know. But if we're about to cut from, similar to what we had here in December, I mean, we started a cut cycle in 2001. And why did we do that? Because the economy was entering into recession and the dot-com bubble was bursting. So what happened? Well, 12 months later, the S&P was down by 15%. Okay, the 2007-2008 rate cut cycle, We started cutting rates, or the Fed starts cutting rates in 2007. This is September or so. And this is because the housing market is collapsing. We're looking at the global financial crisis and what happened there. Well, 12 months after the rate cut cycle started, the Fed, couldn't save the market. They couldn't backstop it. The S&P fell by over 25%. But we know the story, right? We know that from the high to low, that peak to trough was almost 56% on the S&P from 2008 to 2009 until it bottomed. So is it one of those situations again? I don't know. But this was a cut cycle that started that. This was a cut cycle that started the decline in 2001. Are we there yet? I don't know. And maybe that's going to be my theme going into next week is, are we there yet? But if this is where we are at, party like it's 1998 style, then perhaps this cut, it kind of holds off the recession concerns. We kind of stabilize the jobs market. Inflation continues to come in as needed, and inflation comes in lower and trends lower. That's good. But I think it's going to have to be good news on both fronts. All right. So a couple more things here, just currency wise. The dollar is at 100.67. We had a 1 day bounce on the dollar and right back to weakness. I was looking at this on the shorter time frame, and I'm glad that I just stuck to my guns on this trade, because I was looking at this as a potential breakout trade if the dollar was going to go for a bullish pattern. I was willing to take that trade with a stop loss below the U-turn or a swing, but the nice thing is I didn't get suckered in this trade because yes, we broke the trend line, but we did not take out this high, and therefore there was no dollar strength. Now, at this level, what happens next week? We'll find out. But if the dollar continues to stay weaker, if we're below 101, the next logical spot for the dollar is 100. So could the dollar continue to weaken? Sure. And I've actually said this many times this year. If the dollar weakens, then I could see the stock market also gaining strength with a weaker dollar. Okay, risk appetite looks pretty good with a weaker dollar. All right. We also had oil pop today. We had gold pop today. We had Bitcoin up, 64 and change counting, looking pretty good at this stage. Here's silver, also hanging there. They're doing pretty well. Gold just off the all-time highs. Let me switch the time frame up here. So gold, we've had a couple of all-time highs poke this week in gold. We're still bullish on the day. If you're a super short-term trader, I'm sure this has been a noisy spot for you. I'm certainly more medium to long-term. I'm interested in buying additional breakouts or any type of pullbacks, looking to get more exposure in gold. Silver, I'm a little bit more bullish on silver because I can measure that move up to 35 and change. Bitcoin, I'm holding tight. My dollar cost averaging is still in the 30s. I did not buy it right here at 50, but I did buy it on this bear trap low around 55. So I got filled around 55. I didn't get the 50 poke when we had that big sell-off on the 5th of August. But so far is a strong day for Bitcoin. Rates are going to get cut. This could be a good thing. Maybe speculation-wise could be a good thing, but Bitcoin still has to break higher. I think to me the big bull pattern would be that Bitcoin is up above these levels, testing all-time highs, and then any type of pullback in here, game on. And let's see if we can, get to that 100K mark for the year. If that's the case, pretty exciting stuff for any Bitcoin holders, any other exposure to the ETFs and things like that. MicroStrategy was up from 135 to 150 just in the last day. That's pretty awesome. 137 to 150. Ethereum also making a nice little run. I've got a credit spread here on EETH that if we get back above 60 bucks, it's looking pretty good right now. I'm above break even. I collected 760 on the trade. I'm also willing to own this ETF, to own some shares of it and hang on to it. Copper, looking a little bit better for right now. I'm still long-term on copper to the upside. The Nikkei is clinging to these levels. I am watching some commitment to traders reports showing that the retail side is positioning long the Nikkei and the institutional side is short the Nikkei. So as a typical contrarian when it comes to retail trading, I would wonder if smart money, so to speak, is going to be positioning for another drop to the downside on the Nikkei. If that's the case, what happens to the yen? Okay, we'll find out. And then China, nicely breaking the right side of the trend line. I actually added some exposure today on Alibaba and Baidu, as well as FXI. I'm looking to have some China plays and some exposure. Mag 7 did okay today. The big story for me also was watching bonds. You can see that the notes or the actual bond prices were up and the yields were down by quite a bit. The 2-year and the 10-year that we've been watching were now only 12 basis points inverted. But look at these percentages. The 2-year was down 2.24% and the 10-year was down 1.43%. You look at the bond prices between your 1 and 3 year, your 7 to 10, and your 20-year, bond prices are up. Now, they're not ripping like crazy. I'm trying to get TLT to go over 100, but seeing that the inversion is still a part of the yield curve, The 10 and the 2 still inverted by about 12 basis points, but yields dropping and dropping pretty aggressively today. And then bonds steady and green on the day. We will see if this mortgage stuff changes here. 6.46 won't really happen until the official rate cut in September. But does this actually change alongside kind of step for step for the rate cut cycle? Maybe we see this as 6.25. Maybe by the end of the year we're trading at 5.75 or so on the 30-year mortgage. We'll find out. So I think that'll do it. Happy Friday. If you have any questions, you know how to find me. I appreciate you following me out there and boosting this and following my profile here on TradingView and elsewhere. So take care. Have a great Friday, great weekend, and see you soon. Thanks. Bye.